Looking at the performance, we have an order inflow growth of 28% for the quarter, considering that the environment continues to be intensely competitive, investment shy, and with overriding macro concerns. I think it's creditable that the company is able to procure order growth of this order of magnitude. Consequently, the order book is up by 8%. Revenues have been modest at 5% growth over the quarter one of the previous year, but I must add here that these are on planned lines. EBITDA margin has shrunk by 60 basis points, and the profit after tax consequently is lower by 12% as compared to the profit after tax of quarter one of the previous year. Looking into some of the details, we have order inflow for the quarter at 25,200 crores or 252 billion rupees. This in comparison to 196 billion rupees of the previous corresponding quarter registers a 28% growth. We did win in the course of the quarter that we are reporting for certain large ticket wins, including the order that we won for the dedicated freight corridor and a few hydrocarbon orders. Consequently, the growth has been impressive. We also have the orders coming in thick and fast from the infrastructure sector and the hydrocarbon sector, which are the two sectors which are yielding investment opportunities today. In a sense, our wide-ranging skills across several sectors provide a good cushion for us to deal with the cyclical volatility of the various segments that we operate in. And as has been proven over the quarters, there are a few segments which do well, perform well, and they sort of hold the day for the company, being the diverse company that it is. We also continue to see concerns in the power sector. The issues surrounding the sector has not yet got fully resolved, and neither is the issues relating to mining, metals and mineral segment or general industrial sentiment as a whole. So the industrial production figures and the growth figures that we see at a macroeconomic level continue to be very modest, and consequently they do reflect themselves in the businesses that we are engaged with. Looking at the composition of the orders for the quarter one FY14, we have 86% of the orders from the domestic sector and 14% from the international sector. And when it comes to sales, it's 27% from the international sales and 73% from the domestic sales. Insofar as the order book is concerned for the quarter ended 30th June 2014, we have 12% of our order book from international orders and 88% from domestic. So we continue to predominantly execute domestic orders. Insofar as the customer profile is concerned, much of the orders during the quarter one 2014 have been placed by the public sector. 61% of the orders came in from public sector. Things like our win on dedicated freight corridor and Cochin Metro contribute to these percentages. Private sector has contributed 37%, and as you can see, we have not won anything of significance in so far as the concession business is concerned. Sales from international jobs and our exports have done well. They've grown by 68%. 14% of our sales are, 27% of our sales are from international, as you can see. Manufacturing, operating, construction costs have risen by 4%, but the rise is more in line with the activity level, and we did benefit to some extent by the softening commodity prices and the other input costs. Staff costs at 11 billion rupees is up by 23% as compared to quarter one of the previous year, and this is largely on account of additional manpower that we have recruited to execute the growing order book that we have, as well as to position ourselves for an uptick as and when it happens. We also have our usual increments, and as we ramp up our international sites, overseas allowances to be paid to our staff who work out of the overseas projects and offices. Sales administration and other expenses at 5.6 billion has been in line with the activity. In fact, it registers a 1% drop as compared to the quarter one of the previous year. So the total operating expenditure as against a revenue of 125 billion rupees is 114 billion rupees, resulting in an EBITDA of 10.71 billion rupees, which is 1% lower than the EBITDA of the corresponding quarter previous year. It's useful to context the drop in EBITDA to the lesser volume of sales in the first quarter, as well as certain under-recoveries in our capacities, as well as the mix of jobs, which in quarter one is a little more pronounced towards international jobs as compared to the position that is likely to be at the end of the year. Continuing with the earnings chart, we have interest expenses of 2.45 billion rupees, which is 7% higher as compared to the quarter one of the previous year. Considering the interest rate scenario and the liquidity conditions, we find the increase is in order. Depreciation at 2.1 billion rupees represents the capitalization that we have been doing from time and time again for our normal operational reasons. Other income at 4.73 billion rupees is low by 22% as compared to the other income of the previous year's first quarter. This is largely on account of lower dividend receipts from our subsidiary associate companies as well as lower interest earnings. Profit before tax at 10.89 billion rupees is down by 14%, and after tax and adjusting for exceptional extraordinary item which was featuring the quarter one of the previous year, we have profit after tax of 7.56 billion rupees, which is down by 12% as compared to 8.64 billion of the previous year.